Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host Nina Mishra. My guest today is Victor Haghani, founder and CIO of Elm Wealth. Victor was one of the founding partners of Long-Term Capital Management, or LTCM. This was the hedge fund whose collapse in 1998 had sent shock waves through Wall Street and also raised concerns about the stability of the global financial system. And in 2011, Victor went on to found Elm Wealth. And last year, he launched the Elm ETF. So really excited about this discussion. Victor, welcome to the show. Great
Thank you,
having
Nina.
you with us today.
Very happy to be here. Excellent.
So you have had a long and storied career in finance, and the LTCM story is still one of the most fascinating stories in modern market history. And this fund was run by some extraordinarily smart people, including yourself and two Nobel Prize-winning economists. And the hedge fund saw meteoric success and then followed by a dramatic collapse. It's been the subject of countless case studies and the best-selling book, When Genius Failed. Now, some of our listeners may be too young to remember LTCM, and some may only remember the headlines. So could you walk us through what went wrong at LTCM and how that experience changed your investing philosophy? Because I understand that a significant portion of your own family's wealth was invested in the fund as well.
So, I think it probably makes sense to roll the clock back to the beginning of my career. I started working at Salomon Brothers in 1984. Coming out of university, it was my first job. And ultimately, the only, in some ways it was a 25-year stint a 20-year stint of working with the same people, because the people I worked with at Salomon Brothers were the same people that I was partners with at LTCM. So I started in 1984 in the fixed income research area of Salomon Brothers, and then moved to the trading floor after a few years working for John Merriweather, and then eventually was a founding partner of LTCM, the hedge fund, as you said, which we started in 1993. And, LTCM was trying to do the same things that we had done successfully at Salomon Brothers for a long time, longer than I was doing them at Salomon Brothers. I just joined the group after it already was successful for a number of years. And, I think that, one thing that looking back on it, I find, a very interesting insight is just that, doing a leveraged relative value trading from inside of a large financial institution like Salomon Brothers or like the big banks today is just is probably a preferable way of doing it, rather than doing it with a standalone pool of capital that relies on the banks to provide funding. And that seemed to be a pretty strong lesson that we took away from the failure of LTCM. LTCM had a bunch of trades on that we thought had good expected returns, but the markets became very volatile. There were unwinds of similar positions to ours in early 1998, and these different market micro and macro events caused large losses at LTCM. And once the losses were large enough, once we were down, 20% or so, then a lot of attention focused on the positions that we had, and people were worried that they would have to, that counterparties were worried that they would wind up having to hold our positions, and they wanted to hedge themselves, so they would sell some of our positions almost in anticipation of a liquidation of LTCM, which ultimately didn't happen because a consortium of 13 banks bought the whole LTCM portfolio, or recapitalized it and bought 90% of it in late 1998. So I think that the collapse of LTCM is pretty well covered in the academic literature as well as the press and media at the time. There were several books written about LTCM shortly after the collapse. I often think that there were so many more lessons to learn from LTCM that only became apparent years afterward with more time to develop hindsight and consider things with a broader perspective. But for me, I think what I've written about, we have my partner at Elm Wealth, James White, and I have written a book about risk taking and how to avoid losing most of your money in an LTCM situation the way that I did with my family's savings. I think one of the most important and incontrovertible lessons from LTCM has to do with personal investing. So, I think any hedge fund or any investment vehicle can always have bad investment results. And that's why most third-party investors in a hedge fund are allocating a small amount of their capital to each and every hedge fund or private equity firm or venture capital firm that they're investing in. But for the people who are working there, sometimes they get very confident in what they're doing. They have a strong belief in it, and they have also maybe even some incentives where they're not going to pay the same fees that outside investors would pay to invest in the fund. And all of those things together, I think often lead managers to overinvest in their own business, to eat too much of their own cooking. Eating some of your cooking is important. That's skin in the game. It's important as a signal to outside investors. But you don't want to be eating too much of your own cooking because it's pretty risky. You want to be more diversified than that. And the biggest lesson that I took away from LTCM was that it's important to think about your own personal financial situation and decision making. It was really remarkable with hindsight that I started in Wall Street in 1984. I had already studied finance prior to that. And it was only in 1999, after the dust had settled from LTCM, that I really started to think hard and long about personal investing and what would make sense for me and my family as investing. And, and having most of our money in any single hedge fund, certainly, didn't make sense, not to mention all of my human capital and ownership in the business and all of that. So I think that's really, as I said, that's really the lesson from LTCM that I think nobody can argue with, is that there's some thinking about making an investment in your own business that where you have to bring risk into the decision in making it. You need to make a decision that's the best risk-adjusted decision, not just the decision where you have the highest expected amount of wealth if everything goes well.
And in 2023, you wrote a book called The Missing Billionaires, A Guide to Better Financial Decisions. So in this book, you focus on two of the most important investing decisions: what to invest in and how much to invest. So first tell us, who are these missing billionaires, and why do you think investors should spend more time focusing on how much rather than just the what?
So yeah, the title of the book and the jumping off point in the first chapter makes the observation that wealthy families historically have not done very well in terms of maintaining their wealth or growing their wealth. And we have some broad statistics about wealthy families in the past, and we also have some anecdotal evidence too on individual families, such as the Vanderbilt family that had $100 to $200 million at the end of the 19th century, but by 1950 had mostly their wealth had been dissipated through. Mostly, we would say, through bad decisions around risk taking, and the puzzle of the missing billionaires. Why have families had such a hard time with maintaining their wealth and growing it over time? And the answer that we come to is it isn't that they lived in a period of time where investment returns were poor. I mean, much to the contrary, investment returns over the 20th century in the U.S. were tremendously high. Rather, what we believe is that it was making poor risk decisions, making poor decisions around how much to invest in given individual investments, how much risk to take, and how much to spend also. How much to spend and how much variability to have in their spending. That exacerbated things as well. And our feeling is that people spend a lot of time trying to decide on what are good investments and what are bad investments, what they should invest in. And that's important. You need to invest in things that have a good expected return. We wouldn't say don't spend a lot of time thinking about what to invest in, but we would say also spend a lot of time on the how much question, how much to have invested in equities, how much to have invested in things that you really like. If you have a lot of conviction, still, how much should you invest in those things? And the how much question is just as important as the what question. If you invest in the right things, but you invest too much in them, you can be wiped out. That's kind of the story of LTCM. Our investments turned out to be good investments, and there was no feeling that they were bad investments. They lost money, they were too big, and it caused us to not be able to hold on to them, until they did work out. So getting the how much question wrong and the what question right can be really bad. If you get the what question wrong but the how much question right, at least it's not catastrophic. It's unfortunate, and of course you wish that you would get the what question right. But if you size your investments wisely and sensibly, you live to invest for another day, and you survive that. So in some ways, the how much decision can be more of a critical decision. Once you're getting that decision very wrong, that getting it very wrong can be really catastrophic, and it's in both directions, either taking too much risk or not taking enough risk. That somebody who just keeps 5 or 10% invested in equities over time and 90% in bank CDs, that person is really probably wound up with a very suboptimal outcome, even though they're not bust. Just keeping such a high fraction in safe assets, assuming that the person might have believed that the expected return of stocks was high enough to justify more, is maybe not as bad as losing all your money, but it's very bad also. And so that's really the theme of the book. We were really pleased that the book resonated with people as much as it did. We kind of thought it was maybe a little bit on the too technical side, but it seems as though it wasn't, and people have really liked it and given us good feedback.
It's a fascinating book. And apart from the how, not focusing on how much, what are the other most common mistakes you think investors make with their portfolios?
I think that so much has been written about the different kinds of behavioral biases that we have. And, I think that perhaps the one of the biggest of these biases that really is detrimental to investor welfare in the long term is what we would call an extrapolation bias, is looking at the past and believing that the future is going to look like the past, especially the recent past, and leading us to be overinvested when expected returns are low, leading us to hold concentrated positions in things that have done very well. The Mag 7 has done great, so stay invested in the Mag 7, and but you're running a lot of extra risk in doing that. So I think that that the biggest danger, I think, is for investors to extrapolate into the future, too much. I think that's probably away from getting the risk decision wrong that we were just talking about, by either taking too much or too little risk. I think that, looking at the recent past and thinking that's a guide to the future, is really the single biggest one to worry about. And it's interesting that the one thing that financial regulators require all investments to say is future returns, are not. The past returns are not indicative of future returns. I mean, that's kind of the number one piece of boilerplate legal warnings that come with investing. Just as a pack of cigarettes says, smoking, is dangerous for your health. Extrapolating is hazardous to your wealth. I think that with extrapolation comes frenetic trading, and so, I'm not sure that frenetic trading should be viewed as, trading too much and so on. I don't know if that, it's so related to extrapolation that, I might not put that as another one on the list, but that's certainly a manifestation of changing beliefs based on what's happened in the past.
Makes a lot of sense. And on your website, elmwealth.com, you have some fantastic resources, and I totally recommend our listeners to visit your website. And you have some very thoughtful research and a couple very interesting games for investors. And one of them is the crystal ball trading game, or tomorrow's journal today. And then there's the coin flip challenge. So can you tell us a little bit about these games, and what lessons are you hoping investors take away from playing these games?
So the coin flip game, the coin flip challenge, was the first one that we put up on our website as a game. It came from an experiment that we did where we went out to different young, financially trained people working at investment firms or still at university and graduate courses in finance. And we gave them some money, and we allowed them to flip a digital coin that had a 60% chance of landing on heads, which we told them was the case. And we told them that we would pay them whatever money they wound up with at the end, up to a cap based on their flipping, and they could bet as much as they want on each flip. And we were curious as to how would people approach this sizing problem, how much to bet on each flip, under the circumstances. What did they have to draw upon? Did they have some innate heuristics that they would use? Were they taught something in their financial training, whatever. And so it led us to write a paper that was published in the Journal of Portfolio Management, where we outlined our results. And the results showed that people were not very well equipped to make sizing decisions, along the lines of this, and then we put the game on our website so people could play it and see how they do as well, and try to get some insight into their own sizing decisions. So if you have, a trade or an investment that has a positive edge, has a positive expected return, how much should you bet on that? If you would bet your whole bankroll on heads every time in our game, you would have the highest expected return, but you would have the highest probability of losing all your money as well. And, what we found was that very few people did well in our coin flip game, that like 40% of the people wound up either going bust or being left with a small fraction of what they started with. And only a small fraction of people did really well. And then a few years later, we did another experiment where the crystal ball trading game, where we tried to simulate what it would be like for you to be given the front page of the Wall Street Journal one day ahead with all of the news, except for telling you whether stocks or bonds went up or down. But everything but that, would tell you if oil was up or down, for instance, as well, but not whether stocks were up or down. And then you could trade stocks and bonds with leverage if you wanted to. And we wanted to see, could people use that information from the newspaper imagine that you're given the Wall Street Journal a day in advance. And and it's not just for one occasion, we did it for 15 different occasions, which took people about a half an hour to play the game. And again, it was pretty remarkable. People didn't do very well. And we didn't choose the front pages. We chose them randomly. Like, we didn't choose them in a way that would be particularly difficult for people. We didn't choose ones that were just purposefully obtuse or contrary. And again, we hope that people took away from that, that speculating and betting on the market and trying to beat the market and by trying to digest the news better than other people, etc., is probably a losing game, and having a more humble, sensible long-term investment approach is probably the way to go with your savings.
Humble, sensible, long-term investing approach. Very interesting. So is that why you founded Elm Wealth? Tell us more about it.
So yes, well, Elm Wealth was founded before we had our experiments and what we learned from the coin flip challenge and the crystal ball game. But Elm Wealth was very much founded. Well, the origin story of Elm Wealth is that I was searching for how I wanted to invest my family's savings, and I spent a lot of time thinking about different approaches. Did it make sense to try to emulate the Yale model, for instance, or what endowments were doing, which I could probably have tried to do because I was somebody that had been in finance and I knew a lot of these investment managers. So it was feasible that I could have tried to do something like that. Or should I, spend a lot of time trying to generate alpha by finding smart direct investments or being an angel investor in startups? Lots of different possibilities, or going very big into real estate, is another thing that some people do. And ultimately, I decided that I wanted to have a very diversified, low-cost, tax-efficient approach to investing through low-cost index ETFs from Vanguard and BlackRock and iShares, and to manage that portfolio over time, increasing and decreasing exposures as expected returns changed of stocks, as interest rates changed, and as risk levels changed, which is very much a conventional view from financial theory, that what we invest in risky assets should be a function of their expected excess return relative to safe assets and their risk level. So I started investing that way for myself and my family, and talked a lot with friends about it as I was doing it, asking them what they thought and how they thought I should do it and whether they thought it made sense. And after doing it for a little while, a few friends said, Vic, if you do this really formally as a business, we would like you to manage some of our savings too. And so I decided to start a business, and we started off with about, $300-400 million. That was our family, and a number of friends and colleagues from the years. And now the Elm, 14 years later, is managing about $3 billion of client assets, and we've stayed true to the origins of charging a very low fee. We charge just 0.12%. It's probably the lowest fee charged by anybody that's an independent wealth management firm, and that's the only fee we charge. We don't have revenue in any other way from charging people for their for investment management or wealth management. We, as you mentioned, we launched an ETF about a year ago at the beginning of February on the New York Stock Exchange, and actually that launch was a conversion of a private fund that had been in existence from 2011, so it had a longer term track record also, and that ETF has about $500 million in it, the Elm ETF. We've been really, really happy with the business. Our we're 3 partners now. The partnership has grown. Our overall company has grown. Where I think we're about 8 people now. Our head office, our main office, is in Philadelphia, which is a great place to run a business from, and it enables us to keep our expenses really low and charge this low fee of just 0.012%. And we have kind of I think that we've coined the investment approach known as dynamic index investing. That's we have the trademark for that. We've been practicing that for the last 15 years or so, and we think it makes a lot of sense. I think that our ETF is the largest dynamic asset allocation ETF, largest, or one of the or maybe it's the second largest that exists. It's not the largest asset allocation ETF because there are some static asset allocation ETFs that are larger from BlackRock. But among those that change the asset allocation, I think ours might be the largest. Also, our ETF owns some degree of, well, we would say most of the assets in our portfolio are real assets that have some inherent protection against inflation. So that's equities, in general, are inflation, have some inflation protection. We have real estate investment trust ETFs, a real estate investment trust ETF in the portfolio. And we also own inflation protected bonds from the US government. TIPS, is also a part of the portfolio. Not every asset. We also have some treasury bills in there. So not all the assets, we would say, are sort of inflation protected to some degree, but we're one of the few that has that exposure also to real assets of TIPS and real estate in there. So yeah, it's a pretty, we think it's a pretty good vehicle.
So as you mentioned, it charges a super low expense ratio of just 0.24%. That's pretty impressive. And it's barely not even a year old. You converted from a private fund structure to an ETF in February of 2025, and it already has over 530 million in assets. So yes, very, very impressive. Could you tell us a bit more about what it currently holds in terms of the exposure, and how often does it rebalance?
So I should probably just clarify on the fees for a second, because I was saying about how we charge 0.12%, that's what we charge on separately managed accounts. Mm-hmm. And although the stated fee for the ETF is 0.24%, that includes the expense ratio of the ETFs that are in there, which average to about 5 or 6. And then that 18 basis points of fee that's in addition to that, only part of that is going to us, and the rest are expenses of of running the ETF. So we're actually effectively charging less than 12 basis points, as a management fee. But the stated fee again is 24 basis points because it adds all those things together. We rebalance the portfolio approximately once a week, or we're certainly looking at it at least once a week, and usually more often than that. When we do rebalance it, we don't, we know that we tend to rebalance it only part way to what our dynamic asset allocation is calling for, so that we don't generate too much turnover. But it's still, there's quite a lot of turnover there. Being an ETF, we're able to do transactions using redemptions and creations in kind, and also doing tax loss harvesting. So we hope that we can run it tax efficiently over time. Even though we're changing the asset allocation, we hope that we're not doing that in a way that generates capital gains distributed to investors. But, we do our best with that. We don't know how things will go in the very long run. We hold very low cost ETFs in there. The asset allocation today looks something like maybe 20% or 25% in, I should probably just pull it up and read the numbers, but it's about 25% in US equities, mostly represented by the ETF VTI, the Vanguard one that has a 3 basis point expense ratio. Non-US equity ETFs represent about just under 40% of the ETF right now, and that's a combination of European equities, Asia developed equities such as Japan and Australia, emerging market equities, and Canadian equities is all of the different non-US ones. And then on the fixed income side, about around 35% of the portfolio is in fixed income, is in bonds, is mostly in government US Treasury bonds. And I think that, somewhere, that maybe 2/3, something like 2/3 or a little bit less is in U.S. inflation protected bonds, and then the rest of it is some combination of Treasury bills and the U.S. aggregate bond index. So roughly looks like that. The numbers. As I said, that's about close to 70% in equities, just under 70% in equities. Sorry, just over 70% in equities, and just under 30% in fixed income. Is that right? Or just around 70-30, roughly?
Almost 40% to international markets. So I was interested in your thoughts on international markets as well, because last year many international markets had done very well, and that was after many, many years of underperformance. And in fact, the MSCI All Country World ex-US index that outperformed the S&P 500 index by the widest margin since the global financial crisis. And we know that the dollar also posted its weekend posted its worst year since 2017. So US investors earned more returns from currency translation too. So I was just interested in your thoughts on international markets performance, and do you expect that performance to continue going forward because you have a sizable exposure in the fund to international markets?
So first of all, we believe in international diversification. It's kind of a free benefit to get international diversification, also at a very low cost in a tax efficient way. So the baseline portfolio, in our baseline portfolio for the ETF, it's about 45% US equities, 30% international non-US equities, and 25% fixed income. So already that's that 30% allocation to non-US equities in our baseline is already relatively high compared to what most US investors allocate to non-US equities. I mean, I think on average, US investors really have like 10 to 15% of their portfolio allocated to to international equities. And for individual investors, it tends to be less than that. There are so many US investors who have virtually no direct international exposure. Of course, many investors say, well, most of the companies in the US make some of their money abroad. And of course, that's true, but you still aren't getting as much diversification as you could. And also, it's worth noting that the price earnings multiple for US equities is almost double that of the rest of the world. So to the extent that companies are making money abroad, yes, that's true. But you're paying a multiple for those foreign earnings. You're paying a multiple for earnings made outside of the U.S. of double when you own those earnings through a U.S. Equity than you do by owning it directly. And of course, non-U.S. equities, non-U.S. companies make some of their money in the U.S. And when you buy those earnings streams from non-U.S. equities, you're getting them at about half the multiple. So that's where we are today. Of course, 30 years ago, the multiples were pretty similar between U.S. and non-U.S. equities. But today, U.S. equities trade at about a double the multiple of non-U.S. equities. And so, that's why we think non-U.S. equities offer good long-term value. That's why we're overweight non-U.S. equities. Instead of our baseline weight of 30%, we have about 40% in non-U.S. equities. And why we're underweight U.S. equities relative to our baseline. Instead of having 45% in U.S. equities, we have about 27, 28%, just under 30% in U.S. equities, because their long-term expected return relative to safe assets is so much lower. That expected risk premium is so much lower. And, I should say it's not just us that feels that non-U.S. equities offer a higher long-term real return. It's really a consensus view among investment managers. If you look at the capital market assumptions that investment managers all around the world publish on an annual basis, in general, and on average, they believe that non-U.S. equities in the long term will generate a higher return than U.S. equities will after inflation. Now, that doesn't say much about what's going to happen next year or the year after that. And really for the last 10 years, that view overall has been wrong. That U.S. equities have done great over the last 10 years or 20 years. Compared to non-U.S. equities, even though last year was a bit of a reversal. But the last 10, 20 years, U.S. equities have made so much more than non-U.S. equities, that 1 year of non-U.S. equities outperforming hardly moves the needle in terms of that long-term outperformance. But, we still think that it's important to look at cash flows, earnings, think about multiples, and make decisions at least partly based on that, as well as basing asset allocation on risk levels as well.
Makes a lot of sense. We'll have to leave it there, Victor. But thank you so much for joining us today, sharing your excellent insights. Really enjoyed the conversation, and congratulations on the success of the ELM ETF as well.
Thank you so much, Nina. It was a pleasure being with you. Thank you.
That was Victor Haghani of ELM Wealth, and his ETF is the ELM Market Navigator ETF, ticker symbol ELM. ELM, easy to remember. And as he mentioned, it holds low-cost index funds, diversified ETFs, and the top holding in the fund is VTI, the Vanguard Total Stock Market ETF. The second largest holding is the Schwab US TIPS ETF, SCHB, and this has a significant exposure to international markets. As he was talking about, the third largest holding is the Vanguard FTSE Emerging Markets ETF, ticker symbol VWO. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.